Interest rates have continued to move higher. What exactly is causing this increase in rates? What are we going to see next? Let's get to the bottom line. Good morning. Average mortgage interest rates, as measured by the MBA's weekly survey, last week moved higher from 5.94% to 6.01%, tipping above that pivotal 6% mark. That puts us up roughly 3% from last year. Now, the same survey gives us application volume on purchase mortgage loans. That was flat week over week, which puts us down 29% year over year. So some significant changes when we compare interest rates and application volume to this same time last year. We've definitely seen inflation continue to put pressure on mortgage interest rates and move them higher. So looking at inflation, we just got new data from the August Consumer Price Index report, or CPI report. This report showed that overall inflation increased by 0.1%. So that sounds like a very low figure, but it was larger than the 0.1% decline that was expected. Year over year, that puts inflation at a mark of declining from 8.5% to 8.3%, but it was expected to drop down to 8.1%. So as a result of this higher than expected inflation data, the Fed futures, which is a prediction of what the Fed's going to do at their next meeting on September 21st, is now pricing in an 80% chance of a 75 basis point rate hike and a 20% chance of a 100 basis point rate hike. So as we've discussed in previous episodes, these expected rate hikes get priced into the market before they actually occur and are already affecting interest rates, which is also why you don't necessarily see a major move on the day that the Fed announces a rate hike. But of course, inflation, all of this data is impacting rates and the housing market. And one key story here with inflation is the core rate. So Jake, tell us, what is the core rate and what exactly are we seeing when it comes to that?
Yeah, thanks, Kyle. Well, so the core rate of inflation is basically the inflation rate when you remove food and energy from that report. And so the core rate of inflation accelerated up to 6.3% as of August, and that's the highest point that it's been at since March of this year. Now, one of the contributing factors with that is the cost of rent. And what we're seeing is that the cost of rent rose another 0.7% just last month alone, and that puts the cost of renting up 6.7% year over year. Now, this is still one of the biggest factors that is contributing towards driving purchase activity, because realistically, people only have one alternative to buying a home, which is to rent. And that alternative is also steadily going up in cost. So those who are able to make a purchase are actually getting a major benefit where they're able to lock in a significant portion of their housing payment and then also take advantage of dips in the interest rate environment to reduce their housing expense in the long term. Whereas on the opposite side of the spectrum, those who are renting are seeing their rents increase year over year.
Yeah, that's a great point, Jake, and definitely something important for us to keep in mind. The fact that if you own a house and you have an interest rate locked in at 5% or 6%, when interest rates decline, you have the opportunity to lower your housing payment. It's not very common that a landlord is coming to you as a tenant and saying, hey, do you want us to lower your rent for the next lease cycle? So definitely a big benefit to owning a house. When we talk about inflation, one other major sign we're seeing and keeping an eye on when it comes to inflation that's impacting consumers is an explosion in credit card debt. So consumer credit card debt is up 15% year over year, which is a record high. And credit card debt is actually growing at $33 billion per year. And that's double the pace of a normal year. So this clearly shows that people are relying on their credit cards to deal with the higher costs of inflation. And we'll have to keep an eye to see how that plays out, but definitely not a sustainable path when you see that much of an increase in credit card debt, as people are paying very high interest on those debts, of course. We'll keep an eye on all the new data that's being released and news that's coming out and affecting the housing market. We want to look at the most important parts of that data and boil things down in each of the next week's episodes of The Bottom Line so that you have the key information to stay aware of. So thanks for tuning in, and we'll see you next week.